Welcome to the Deep Dive. Today we're really diving into a complex mix of global reports and events.
Yeah, quite a stack.
We've got JPMorgan on trade, RBC looking at Europe, Bank of America on oil prices.
ECB rates, Yardini on geopolitics.
Plus a whole lot on AI stocks, Microsoft, Google, AMD, Marvell, and UBS on China's AI goals.
And that big power outage in Spain and Portugal, Bernstein's take on that.
Right, and some interesting Wall Street calls. And of course, the breaking news. India and Pakistan agreeing to a ceasefire brokered by the U.S.
It's a lot to unpack.
It is. Our mission, as always, is to pull out the key insights for you, try and make sense of how these pieces fit together, and what it might all mean going forward.
It really shows how connected everything is, doesn't it? Trade policies impacting energy, central banks, even, like you said, AI investments.
Definitely. So let's kick off with that trade angle. JPMorgan is waving a bit of a warning flag, drawing parallels between the U.S. direction now and the UK's Brexit experience. They're calling it slow damage.
Yeah, it's an interesting comparison. They're looking at the sort of underlying drivers that discomfort with globalization, immigration concerns, worries about manufacturing jobs leaving.
Similar vibes in both situations, you mean?
Kind of, yeah. And the UK's path after Brexit, well, it wasn't an immediate crash, which might be the point. It offers a glimpse into how shifting away from global integration can sort of gradually erode economic potential over time.
Right. It wasn't like a cliff edge for the UK initially, was it? I think the report mentioned some resilience at first.
Exactly. They had some export growth early on, partly because the global economy was doing okay, and those trade deals didn't just vanish overnight because of the negotiation period.
Okay.
But domestically, things looked different. Consumer spending cooled off, and business investment just sort of stalled. That domestic hit is a key part of the warning, I think.
So what are the specific ways JPMorgan sees this slow damage playing out? They mentioned three main channels.
Yes. Three key things they observed in the UK. First, reduced trade intensity. Basically, the UK wasn't trading goods as much as it probably would have. Without Brexit, they put a number on it, around 15% lower.
15%, yeah.
Second, a drop in work-related immigration from the EU. That went from, maybe 0.4 or 0.5% of the workforce down to about 0.1% by 2021, creating labor shortages. And third, a long-term slump in business investment. By 2019, they were lagging quite a bit behind the US and Eurozone in capital investment, maybe a 15% gap, and that hits productivity growth too.
That sounds like a serious drag if it persists.
Yeah.
And the kicker is, apparently now a majority in the UK might actually want back into the EU.
That's what the poll suggests, yeah. So the lesson JPMorgan is pointing to for the U.S. is this risk of gradual erosion, not necessarily a sudden crisis, but a slow weakening.
So if our listeners are trying to track if a similar slow burn is happening here, what should they maybe keep an eye on? What are the signs?
Good question. I'd say watch business investment trends closely. Are companies pulling back on big long-term plans? Also, look at trade volumes. Are they noticeably shrinking with key partners?
Okay.
And maybe labor markets too, especially in sectors that often rely on global talent. Persistent skills gaps could be another, indicator.
Makes sense.
Yeah.
Okay, let's hop over the Atlantic. RBC Capital Markets, they're looking at European markets and saying tariff concerns are already kind of baked in.
Yeah, they've noticed things have calmed down a bit recently, volatility-wise. And that expected big shift of money from U.S. stocks to European stocks, it seems to have stalled out.
Why is that, according to RBC?
Well, they draw this useful distinction between soft data, like confidence surveys, how people feel, and hard data, which is actual economic activity, like retail sales or GDP numbers.
Right.
And interestingly, while the soft data in the U.S. has looked a bit weaker lately, maybe reflecting those tariff worries, the recent hard data out of Europe, like their Q1 GDP, was actually better than expected.
So even with all the talk about tariffs, Trump's announcements, the 90-day pause for most places, but not China, obviously, they're facing huge tariffs and hitting back.
Right. China's facing at least 145% tariffs and retaliated with 125% levies. Big numbers.
But despite all that, Europe's actual economic engine is running a bit stronger than feared.
That seems to be RBC's read. The initial tariff shock caused jitters, sure. But the pause for many countries, plus that decent hard data, created what they're calling a calm after the storm. Plus, you had the US Q1 GDP actually contracting, partly because imports surged before potential tariffs hit. So the picture is mixed.
And looking ahead, RBC seems more confident about a steeper yield curve and maybe a weaker dollar. What does a steeper yield curve usually tell us?
Generally, a steeper curve, wider gap between long and short-term rates suggests markets expect stronger growth, maybe higher inflation, and potentially higher interest rates down the road. So RBC might be thinking the worst of the tariff fears are easing for now, Europe's holding up okay, and maybe the dollar weakens a bit due to trade friction or other factors.
Got it. Let's switch over to energy markets. Bank of America is floating this idea of a slow wear oil price war from OPEC plus yelling. Sounds deliberate.
Yeah, OPEC Plus decided to bump up production slightly. The actual amount isn't huge. BOFA thinks maybe 170,000 barrels a day net increase, but the reasoning is key.
And what's the thinking? Especially for Saudi Arabia.
It looks like they're focused on regaining market share. They've got a lot of spare capacity just sitting there. And, with the world eventually moving towards renewables,
right,
they might figure, let's pump more now while the demand is strong. For you filling up your car, this could mean maybe stable or even slightly lower gas prices for a while.
And that could potentially help the broader U.S. economy, right? Lower energy costs, offsetting some inflation from tariffs.
That's the potential silver lining, yes. Lower energy prices can definitely cushion the blow from price hikes elsewhere.
But BOFA says this isn't like past OPEC price wars.
Right. Those were often triggered by big, immediate shocks. The Asian financial crisis in '98, U.S. shale boom around 2014, the COVID demand collapse in 2020. This feels more strategic, more long-term. A slow wear, as they put it.
Okay, a slow wear war. What are the risks BOFA sees with this strategy?
The main risk they flag is to their own oil price forecast. They've been predicting Brent crude might hit $70 a barrel by 2026. If OPEC Plus keeps slowly turning up the tap, that $70 target looks less likely.
Interesting. That could ripple through the whole energy sector.
Absolutely. Affects company profits, investment decisions, a whole 9 yards.
Okay, now let's look at Europe again, specifically interest rates. Deutsche Bank sees two potential paths for the European Central Bank, the ECB. What's their base case?
Their main scenario, their base case, is for the ECB to cut rates 3 more times during 2025. That would take the key deposit rate down to 1.5%.
Following the cut they just made?
Exactly. And they're seeing inflation trending down pretty consistently over there. Headline, core, even services inflation is easing off.
But they also see risks, right? Two different ways things could go.
Yeah. Two main risks that could push the ECB off that path. First, a potential growth shock. If those delayed U.S. tariffs eventually hit hard and really slow down the Eurozone economy,
then they might cut more.
Potentially, yeah. They might feel they need to go below that 1.5% target to give the economy a boost.
And the other risk?
The flip side, unexpected economic resilience. If the Eurozone economy proves tougher than expected, shrugs off the global headwinds better, well, then the ECB might hit pause on the rate cuts before reaching 1.5%.
And the ECB itself is acknowledging the uncertainty from trade tensions, isn't it? Saying it could hurt confidence.
They are. They've explicitly mentioned increased uncertainty and potential hits to household and business confidence. They even put a number out there suggesting Eurozone growth could be chopped by 0.5 percentage point if significant tariffs are imposed.
So trade policy is really casting a long shadow over monetary policy decisions there.
Absolutely. It's a huge variable for the ECB right now.
Okay, let's broaden the lens to the geopolitical landscape. Your Denny research had a pretty stark take, calling geopolitical crises the most spectacular and reliable bull market of 2025. Wow.
It's a provocative phrase, isn't it? But their point is that instability and uncertainty seem to be, unfortunately, a constant and driving force in markets right now.
And what are they pointing to specifically?
It's a combination of things. That sudden, really worrying flare-up between India and Pakistan, two nuclear powers.
Yeah, that was concerning. The reports of missile strikes.
Very concerning. Pakistan claiming retaliatory strikes on Indian bases, India condemning it. It was a sharp escalation.
And then you have the ongoing U.S.-China friction.
Right. The tariffs are causing real pain, apparently leading to public protests in China. Your Denny mentioned a figure maybe up to 20 million Chinese jobs could be linked to shipments to the U.S. That really shows the scale of what's at stake.
Huge numbers.
And then Trump's stance that the U.S. does not need to sign any trade deal except that specific one with Ukraine. It just adds to the global trade uncertainty.
Plus, the Middle East is still very tense.
Still very volatile. You had the initial U.S. strikes on the Houthis, Trump then claiming they'd capitulated, which seemed maybe premature, and the big question marks still hanging over Israel and potential action against Iran.
So the big picture from your Denny is just instability everywhere.
Pretty much. Political instability overshadowing the global economy, making traditional safe havens harder to find. It feels like geopolitical risk is really front and center for investors.
Yeah, but on a more positive note, there's that breaking news about India and Pakistan. A ceasefire.
Yes, thankfully. It seems U.S. brokered talks have led to an agreement. Trump announced it as a comprehensive and immediate ceasefire.
How did that come about after the recent tensions?
Well, as we mentioned, things got very heated. Pakistan claimed they hit over 25 Indian military sites with Fateh missiles after alleged Indian actions. India called it a flagrant escalation, reported shooting down drones. So the U.S. stepping in to facilitate talks seems to have pulled things back from the brink, at least for now. Trump praised both sides for common sense and great intelligence.
Well, any de-escalation there is definitely welcome news. Let's hope it holds.
Absolutely.
Well, let's shift gears completely now. Artificial intelligence, always moving fast. We're seeing some interesting analyst calls in the AI space. What's the trend?
It feels like analysts are getting more granular, moving past the everyone benefits from AI phase and really digging into specific companies, valuations, competitive positioning.
Like Phillip Capital, downgrading Microsoft.
Yeah.
Even with good results and things like Azure and Copilot looking strong, they cut it to hold.
Yeah, their issue wasn't the business, it was the stock price. They basically said, look, Microsoft is incredibly well positioned for AI, no doubt, but the stock has run up so much, maybe the valuation is stretched in the near term.
So still positive long term, just maybe less upside right now. Their price target is still $480.
Exactly. It shows valuation discipline is creeping back in, even for the big AI winners.
Okay, but then Jefferies looked at Google's recent stock dip, which happened after Apple said some things in that antitrust case and called it an overreaction.
Right. Apple apparently testified that their Safari search volume was dropping, hinted maybe AI search could bypass Google.
But Jefferies isn't buying that as a major threat to Google.
Not really. They point out Google's own AI overviews feature is being adopted incredibly fast, like 1.5 billion monthly users already.
Wow.
Plus, Safari's overall search market share isn't that huge compared to Google's dominance via Chrome and its own iOS app. Jefferies kind of hinted Apple's comments might be, strategic positioning for the lawsuit.
Plausible.
And they also noted Google's valuation looks pretty attractive, near a 10-year low on an EV to EBITDA basis, so they see the dip as a buying opportunity.
Interesting contrast. Now, Wells Fargo's Christopher Harvey is saying maybe it's time to look again at the AI tools and shovels plays, the infrastructure providers.
Yeah, his argument is that after some declines this year, there's value emerging in the companies that build the foundations for AI, the chip makers, the data center companies, the software tool providers.
The picks and shovels in the gold rush analogy.
Exactly. He makes the point that this AI boom is being driven by companies that are actually profitable with strong balance sheets, unlike some past tech bubbles.
Right.
And he talks about this symbiotic iterative cycle, basically. Better infrastructure enables better AI applications, which then drives demand for more infrastructure. It feeds itself.
Makes sense. And he thinks these companies might be somewhat insulated from macro pressures.
Yeah, partly because data center projects have really long lead times. And he also downplayed the tariff impact on things like GPUs and servers, saying they're mostly USMCA compliant anyway. Wells Fargo even put together a portfolio of 25 of these tools and shovel stocks.
Okay. Then we have Bank of America upgrading AMD, big upgrade to buy, $120 target. What's driving that optimism?
BofA sees significant growth potential for AMD, maybe over 20% revenue growth. They liked the Q1 results. The Q2 outlook looks strong despite some China issues.
What are the key drivers?
Several things. Continued market share gains in CPUs against Intel. They think AMD's AI GPU sales targets are achievable, especially with the new MI350 chip coming. Potential for better profit margins. And again, valuation, they see it as attractive.
And they think AMD's average selling price for PC chips could actually beat Intel's.
Yeah, they project that could happen, which would be only the second time ever. So quite bullish on AMD's execution.
But it wasn't all upgrades. Cantor Fitzgerald downgraded Marvell Technology. Cut the target to $60, neutral rating. Why the caution there?
That one sounded more concerning. The downgrade was linked to worries about Marvell's custom silicon business. Apparently, there are reports they might be losing some key customers, specifically Amazon and Microsoft.
Ouch. Losing big cloud players like that would hurt.
Yeah, Cantor is worried about the profit outlook for 2027 if that happens. And Marvell also postponed their investor day, which often signals some uncertainty or maybe strategy shifts are underway.
Right, not usually a bullish sign.
Yeah.
Okay, shifting focus a bit. UBS looked at China's big push for AI self-sufficiency. What's their assessment? Strengths and weaknesses.
UBS sees China as being pretty strong on the AI application side, using AI in various industries, powered by their huge internet companies and lots of developers.
But the foundations are weaker.
That's the challenge, yeah. The enabling layer advanced semiconductors, the core computing infrastructure needed for cutting-edge AI, they're making progress on chip self-sufficiency, maybe getting to 27% by the end of 2025.
Which is progress, but still leaves a big gap.
Exactly, especially compared to leaders like NVIDIA in terms of raw AI computing performance. UBS expects Chinese domestic AI hardware companies to gain a lot of market share within China, maybe 90% by 2029.
But at a cost.
Potentially, yeah. Maybe lower performance or less pricing power compared to the global leaders. Still, the overall domestic AI computing market in China is expected to grow massively.
So UBS suggests investors maybe need exposure to both global leaders and some Chinese players.
That seems to be their recommendation, yeah. Hedge your bets, essentially.
Okay, let's talk about a different kind of infrastructure failure, that big blackout on the Iberian Peninsula. Spain, Portugal, parts of France. Bernstein analyzed this. What's their takeaway?
The big takeaway, according to Bernstein, is that this is a major wake-up call for grid operators and policymakers, not just there, but across Europe.
Even though they don't know the exact cause yet, they ruled out cyber attacks and weather, right?
Correct. The cause is still uncertain. Theories range from problems handling excess solar power, weird grid oscillations, maybe just poor grid management. But the scale of it losing 15 gigawatts, like half of Spain's demand at the time, that highlights the vulnerability.
So for listeners, it's a reminder that even modern grids can be fragile.
Definitely. Bernstein thinks this will inevitably lead to a bigger focus and more spending on making grids more flexible and resilient.
How?
Things like better grid management systems, maybe more energy storage, and potentially beefing up the interconnections between the Iberian Peninsula and the rest of Europe's power network.
And who benefits from that?
Grid companies like Red Eléctrica in Spain could see more investment. And companies involved in the distribution networks, Endesa, Iberdrola, Naturgy, EDP, might also see increased spending in this area.
Makes sense. Okay, finally, just a quick roundup of some other Wall Street calls we saw.
Yeah, a real mix.
JPMorgan upgraded Wendy's to outperform. They like the cash flow and growth story. Monis, Crespi, Hart downgraded Coinbase to neutral. Some near-term worries, but still positive longer-term.
Crypto remains volatile, I guess.
We already mentioned BofA upgrading AMD. RBC Capital upgraded Mosaic. The fertilizer company seeing tight phosphate markets.
Interesting commodity play there.
And Goldman Sachs upgraded Lyft to buy, thinking maybe the market's fears about their growth are overblown. $20 target there.
So yeah, analysts constantly reassessing based on company specifics and the broader environment.
Absolutely. Okay, so let's try and wrap this all up. What does it all mean for you, our listener? We've covered a lot of grounded potential long-term trade effects, delicate energy market balances, the AI race heating up, infrastructure fragility, geopolitical hotspots.
And that sudden ceasefire, which is, a hopeful sign amidst the tension.
It really underscores how interconnected everything is, doesn't it? Trade, energy, tech, politics, it all weaves together.
It does, and I think the big picture view highlights why it's so important to keep track of these seemingly separate developments. They really do influence each other and can impact, your investments, your job, the economy you live in.
The world's definitely not standing still.
Not at all. Constant flux.
So, considering that interconnectedness, here's a final thought to leave you with. How might something like that slow wear oil price war we talked about, how might that interact with trade tariffs? Could lower energy prices maybe make tariffs easier to swallow politically, or could they complicate things for central banks trying to manage inflation? And how might that then ripple back and affect the investment case for, say, those AI infrastructure companies?
Yeah. It's a complex web of cause and effect. Definitely something worth mulling over as you navigate the week ahead.